Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts.
I mean, ultimately, when we were in the perfect storm of credit. We had all that money being recycled in from China. We had all that money being created through the derivatives, and I don't think we're going to see that storm again that pumped up our asset markets and falsely pumped up what we thought was wealth in our 401ks and our houses. Now we're realizing there wasn't real wealth there. Ultimately, real wealth comes from what our parents have been telling us all along, saving your money and not building up that credit card. That's where wealth comes from.
Good point. Jack, a comment, but a question from Robert. Why is it when stocks go down, the dollar tends to go up? And you touched on this, but if you wouldn't mind just repeating it.
Sure. What we're seeing, the stock market, if you think of the stock market as the major risk asset class in the world, it's the major repository of risk asset, meaning a bond is considered more safe. Obviously not all, but safe bonds. But stocks are risk asset classes. And when you have risk appetite, meaning people want more risk, you tend to see money move into stocks, move into global equity markets. And right now, because of the capital gains opportunities, the movement up in stock markets means people are tending to move into other stock markets offshore for those bigger capital gains opportunities and away from the dollar, out of the safety of the treasuries. You also see the treasury bonds moving in that same direction. If stocks were to fall, the dollar was to go up, you see treasury bond prices go up. Again, that flow from that risk asset class into a more safer class of assets. It has not always been the case that this correlation is so tight, and it may not be the case in the future, but there's no doubt that the stock market is exactly playing that role right now. So think of it as an ebb and flow from risk appetite back to risk aversion when the stock market falls, and back more into treasuries and a little bit away from these risk asset classes offshore.
Interesting. Sigmar wants to actually has, and I'm not sure I understand his question. Maybe you will, Jack. He says, what is exactly the problem with the dollar? I guess maybe what is he trying to say, that we've been in a dollar bear market for 6 or 7 years, Jack? Maybe that's what he's trying to say. Why is that? Why is the dollar losing its value over that last 6 or 7 or 8 years?
Well, I think before, as I showed that implicit weak dollar policy, I think the government was very, very happy with a consistently falling dollar in the past that created this major bear market and the major negative sentiment against the dollar. Because what was happening during that last bear market cycle, when the Fed pushed interest rates down to 1% back in 2000, and the dollar just started getting killed as they were pumping more and more dollar supply out around the globe, what was happening was we were seeing that symbiotic relationship with China sending us stuff that we were paying for with cheaper and cheaper dollars. The U.S. consumer's purchasing power was increasing relative to the fact that China kept sending us more and more stuff, and that dollar credit going out around the world was pumping up stock markets, and it was pumping up the housing market. So that was implicitly a part of the policy, and also was pumping up U.S. corporate earnings, because when they earned money overseas, our multinational corporations, and then brought them back to the U.S., earnings were pumped up, and that added to that self-feeding process in the stock market. So it was something that the U.S. government liked. As I said, the credit crunch, we think, ultimately is changing that game. But at the moment, because of what we just talked about earlier, this change of the what was called the Washington Consensus, and the U.S. being the stimulator of last resort and throwing all this money back into the market, trying to create that idea that the U.S. dollar should, again, pump up all global asset markets, the dollar's starting to fall again, and the concern is that this is a policy that the U.S. wants, an implicit weak dollar in here. And the market so far has been very, very right on this. Regardless of what I think fundamentally long-term, the reality is the dollar's still in a very, very nasty downtrend, and I think it's because of this debt telling the market we want an implicit weak dollar again to try and pump up asset classes and build consumer wealth again. But we have to be very, very careful because now that people are warming up to the stock market again, feeling better about the wealth, the housing market, that other major source of consumer wealth, hasn't responded yet. If the stock market comes off again, then this policy of throwing all this debt into the market is going to look very, very silly. But I think that's what the market sees at the moment, and the market is obviously is right about it because the prices don't lie.
At least in the short term. Question that you or I really can't answer. Samuel wants to know where we expect the Canadian dollar to trade relative to the U.S. by December. I think, Samuel, what I tried to show you is it's really up to you. If you believe that the green shoots idea is false, you're going to think more than likely that the dollar, U.S. dollar, greenback is going to gain value against the Canadian. But if you believe that the global markets will continue to grow, then the Canadian dollar might even go to parity. Jack, what do you think?
Yeah, there's no doubt. And there's also a third scenario in which you could see the U.S. start to come out of the recession, or at least the perception that they are, a lot faster than Europe, and the emerging markets still growing and the U.S. growing much faster than Europe. And then you would see the commodity currencies and the dollar tend to move up together relative to the European pack. So there's three choices there, Steve, that I do think are very much still on the table.
Interesting. I mean, just remember, you have these options that are out there. So whether you think it's going to be a huge run, maybe an out-of-the-money call or an out-of-the-money put or a moderate move, they're out there. And again, the symbol is CDD. And please sign up for the Currency Currents, as Jack will frequently talk about the Canadian dollar. So at least you can stay tuned to what he's thinking. And again, that you can go right to the website and sign up. Bin wants to know, what is Chinese export contribution to its GDP and GDP growth rate? Jack, I'm not sure if you know those numbers offhand, but I'm always amazed that you seem like you have numbers at the tip of your head that I just can't believe. But I'm not sure if you know any of those export numbers.
Yeah, it's about 32% of their GDP, down from about 42% 10 years ago. So the relative component of domestic side consumption has declined as a growth driver for China, which gives an indication of how much more they've depended on this export-driven economy.
Very interesting. Jack, it's always amazing that you have those stats at the tip of your tongue. Thank you.
Sure.
Another question, what is the short-term, intermediate-term trend and long-term term broad-based outlook of the equity markets in lieu of Jack's current analysis of the dollar and its possible impending trends? Well, I think that was sort of a long question, but I think Jack sort of gave us his views, the idea that if you believe that the global markets will continue, in fact, he just actually summarized it just a second ago relative to the Canadian, but you could use the Australian, you could use the New Zealand, any of the commodity currencies. You can look at what's going on in the equity markets and sort of interpolate what's going to happen to the currencies. Correct, Jack?
That's right, and that's exactly right. They tend to move as a block, the commodity currencies, not only just the major currencies, but some of the emerging or developing nation commodity currencies tend to move, as a block too, which would include, things like Brazil and South Africa and those types of things.
Interesting. Has a question for me, and she wants to know if you can close out your position early. Since they're European style, does that mean you cannot close them out early? Sarah, European style means that you cannot exercise them early, but you can always close them out. So if you buy a 4-month option, I showed you some of the December options. If you bought a December option and a month or two from now, either you're really right or really wrong, or maybe you're moderately right or wrong, but you just wanted to close out your position, you could do that. So yes, you can, just like stocks, you can close them out, but they are European style, which means that you cannot exercise them early. In most cases, you're not going to exercise an equity option early anyway. So I feel that European style options are actually a little more straightforward, because that if you get in a position, if you sell an option, maybe a credit spread, you're not going to be assigned early.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.